Welcome to Yahoo Finance Live, and happy Friday to all of you. I'm Akiko Fujita along with Josh Lipton here at the New York Stock Exchange. We're taking a look at some of the top stories of the day. Here is your big three at 3. Upping the ante, the UAW keeps its word and doubles down against GM and Stellantis, hitting 38 more parts and distribution centers in 20 states. It says Ford is coming to the table. Will this move forward the hand of Detroit's other two auto giants?
And the mega deal that might just happen, Microsoft moving closer to finalizing that $69 billion purchase of Activision Blizzard. The UK's competition watchdog saying the new proposal should be enough to address competition concerns.
And the proof is in the pudding. You can finally get your hands on the new iPhone 15 and 15 Pro. The highest end model will set you back a cool $1,200. Do you want it bad enough? As the tech giant's hurdles mount, Tim Cook's company sure hope so. Let's get you up to speed as always, though, on the market action. We've got an hour left to go in the trading week. We've got the Dow down 26 points here, trading pretty flat, let's say. The S&P 500 in positive territory, as is the NASDAQ. All three majors right now looking to hoping to snap a 3-day losing streak. Bond yields have certainly been in focus since we got that FOMC decision on Wednesday. The 10-year yield pulling back just a bit, though still very elevated at 4.44. And just a reminder, we hit that highest level we've seen on that yield there, at least in 15 years. So we're going to be talking about that a little later in the show. But Josh, all eyes yet again on the big three over in Detroit because of some developments.
That's right. So let's dive right into our top story of the day here. UAW President Shawn Fain announcing this morning that the union will be expanding its stand-up strikes against GM and Stellantis.
So today at noon Eastern Time, all of the parts distribution facilities at General Motors and Stellantis are being called to stand up and strike. We will be striking 38 locations across 20 states, across all 9 regions of the UAW.
Yahoo Finance's Praz Subramanian has been tracking the negotiations and joins us now. Praz.
Hey, Josh. So yeah, the UAW expanding those stand-up strikes, though only at GM and Stellantis parts and distribution centers. As the UAW president Shawn Fain said, it had made real progress, quote unquote, with Ford, but not the other two. So with Ford, Fain says the union secured COLA reinstatement, right to strike at closed plants, enhanced profit sharing, immediate conversion of temp workers. That's a big one, among other things. Fain said Stellantis and GM need some pushing in this regard. Now, the reason why the parts facilities were chosen is because the UAW says those workers are stuck at a lower wage rate than current union members.
Pras, is there an argument to be made here about the pressure that was on Ford? You know, obviously the UAW coming out and saying they feel a little better about where they are with Ford, but part of that is also because they have a higher number of hourly workers in the U.S. Is that right?
Well, it seems as though he went through a couple of slides during his presentation and showed that Ford had made, the things I mentioned, the temporary workers converted to full-time, the COLA reinstatement, the enhanced profit sharing for workers. These are the things that GM and Stellantis did not agree to as of yet. So that is real progress from their point of view. Obviously, there's still probably a gap with regards to things like defined pension plans and actually the 30 to 40% wage hike that they might be seeking. So there are some big sort of moves that Ford did that GM and Stellantis are still sort of arguing about with the union. So I think that's why they sort of let off the hook here with this the expansion of the stand-up strikes.
And Praz, why is the UAW deciding to go after the parts distribution centers? Why are they targeting those centers? What's the tactic?
You know, when I first heard that they started to target these parts and distribution centers, I thought, this is sort of a reprieve for the big two, I guess, for Stellantis and GM, because they didn't go after their profit centers, which are the big truck factories. But we spoke to Dan Ives earlier today, and he spoke about how the parts and distribution centers are actually the hearts and lungs of the businesses, because you need those parts to go to the factories to build other cars, but also on the consumer level, they need parts for repairs. So it would kind of put pressure on the big three and big two, what do you want to call it, to make a deal. Because if your consumers are wanting parts at the service center and they can't get it, they might blame the automakers.
Praz, thank you so much for that. We appreciate it.
Thank you.
And the UAW is expanding, as we noted, its strike knowing they have the support of the American people. 75% of Americans support workers going on strike to negotiate for better wages, benefits, and working conditions. That's according to a recent poll from the American Federation of Labor and Congress of Industrial Organizations. For more on the summer of strikes, we're going to welcome in here Mary Kay Henry, SIEU International President. So, Mary, interested first of all, just to get your take on this strike, where we are, Mary, and how you think this gets resolved.
SEIU members are proud to stand with UAW members that are shining a light on record profits by the big three need to translate into record contracts for the auto workers. And we are proud to stand up with them as they expand this strike and make crystal clear to major CEOs in the American economy that their profits need to be invested in the frontline workforce that generates the profits.
Mary Kay, we're just 1 week into this strike. There was a question about how much leverage you think the UAW has. The argument on the side would be, of course, that this is at a time when these big three, along with the rest of the industry, is going through an incredible transition into EVs, and there's a lot of money pouring in. Does that strengthen the hand for the UAW as you see it?
Yes, I think working people understand that our government is making a major investment in the expansion of this sector of our economy, and it's going to happen right here in the United States of America. And given that workers sacrificed back in 2008 to get this industry standing back up again, it's time for these three CEOs and the three companies to invest in the frontline workers. And those workers are going to be responsible for helping to create the clean energy transition by building electric vehicles.
And Mary, I'm interested just to pull the lens back. It's such an interesting moment in time for the U.S. labor market, Mary, because yes, we can talk about these strikes in Detroit with auto workers, but as you know, Mary, there's strikes going on across so many different kinds of companies and industries and sectors. So auto workers, but also airline pilots, UPS workers, Hollywood actors and writers. I know that's a lot of different sectors and industries and markets, Mary, but do you think there's any kind of unifying theme there that's some explanation of why we see this rise of organizing activity?
Absolutely. Companies are generating record profits, and they need to be invested in the workers that carried us through the pandemic, that are moving through extreme heat and continuing to make our airports run as the service workers who do baggage handling and cabin cleaning do every day in our nation's airports. Starbucks workers are trying to organize and join a union because that's a very profitable company that needs to create a seat at the table and a voice on the job for those workers. And so I think the common thread between all these workers is enough is enough. You're doing better as a company. I need to be able to do better as a working person in this country and work hard for a living in one job where I can expect that my children are going to do better than I've done.
And Mary, would another reason, though, also be there that union leaders are looking at the labor market and they see a sturdy labor market, low unemployment, sub 4%, and they think now is the time to strike because now they have leverage?
You know, I actually think the conversation is different because working people have to take a huge economic risk to decide to go on strike, whether it's a tight labor market or a loose labor market. And I think what's happening across the economy is workers are taking inspiration from each other. Auto workers got to see UPS workers threaten a strike and have a history making contract. Hollywood and SAG-AFTRA workers are on strike demanding more from Hollywood, and then the UAW workers join them. We have Kaiser Permanente workers who just set October 3rd and 4th for their strike date from a major healthcare company along the West Coast. So workers understand that they deserve better, and they're standing up together to make it happen.
Even with that said, when you look at where the labor movement is, or specifically what part of the workforce is organized, we're still talking about roughly 10%, which of course pales in comparison to the peak. Do you see this as a way to sort of move the needle forward on that? And what are these high profile strikes do to that conversation?
I absolutely do see it as a way to move the needle. Our union just backed 550,000 fast food workers who won a seat at the table with franchise owners and the state government in California to create a $20 entry-level wage next April 2024, and then continue to bargain additional increases every year, and finally address harassment on the job and crazy scheduling that doesn't allow people to live a decent life. They're being inspired by Starbucks workers who've been organizing and trying to get a first contract from that company for over 2 years. And then we get to see the Writers Guild of America almost on the precipice of a settlement after their strike, and the UAW workers expanding their strike. And so it builds people's confidence that when we join together, we can actually win a better and more just society for everyone.
Mary Kay Henry, SIEU International President. It's great to talk to you today. Appreciate the time.
Thank you.
Well, the tech IPO freeze melting in September with IPOs from Arm, Instacart, and Klaviyo. But what has Wall Street had to say since these public debuts? We've got Yahoo Finance's Jared Blickery on the case. Jared.
Hey, Akiko, good to see you up here the entire week, by the way. Let's go to the Wi-Fi Interactive. That's where our story unfolds here. Taking a look at the U.S. IPO market, and we'll get to some analyst commentary on the latest one in a second. Just want to show you, going back to 2021, how much, and remind everyone how much the deals thawed last year. There was almost no activity, and now we've seen activity just pick up a little bit here, whether you talk about number of deals or the deal value. But we want to talk about ARM and also some of the newer ones. And when you take a look at the street, first of all the issuers that participated in the underwriting, they're in a blackout period, so they're not going to have opinions about this that they can publish for several weeks. But we do have one sell, 3 hold equivalents, and 1 buy on ARM right now. And it's important to note that this is a company that's been around since 1990. It's a large one. Market cap is $52 billion. And if we take a look, I do have some notes from Susquehanna. They have a price target of $48 with a neutral rating. And what they're saying is the company, this is a quote, the company appears to be pushing royalty rates to the limit while also adding lower margin subsystems revenue. And then Bloomberg summarizing the note says, with Susquehanna, there are now 3 firms that have equivalent of a hold rating on the stock compared with 1 rating and 1 sell. And we can also take Instacart and Claviyo. Some interesting commentary there as well. Here's Instacart. You can see we have only 2 holds, no sell, no buy right there. And I have BTIG comments on them. We'll pull that up in a second. And I should also note that IPOs have not fared that well this week, at least the stock, the ones that have recently listed, and that's in line with the general market. We've seen stocks under a lot of pressure over the last 2 days. But back to the main point, here's what BTIG is saying about Instacart. Jake Fuller over there is saying that the company has a fair valuation based on modest growth potential and challenging competitive dynamics with its peers, which are DoorDash and Uber, and also writing, while there are positives for card and competitive positioning, low category adoption, ancillary opportunities, and healthy margin profile, we see valuation as fair relative to modest top-line prospects. There was concern over a revenue slowdown, at least a revenue growth slowdown. But let me just show you what's been happening since it listed earlier this week. You can see that $30 IPO price, and it is right there, right at that place where it sold shares to insider investors, and it's down quite a bit from where it originally popped that first day. Now you take a look at ARM Holdings, that stock is underwater here, and then Claviyo as well. But that stock is actually up 10% from its IPO price, but down from its first day high. So interesting mix to take a look at there. And I do have some comments from Bloomberg Intelligence on Claviyo. They're seeing a surge in sales in an IPO that topped its fundraising goals, but it faces challenges in broadening its app portfolio and deepening its e-commerce to reach Wix, Salesforce, Commerce Cloud, and others. So not the best week maybe to debut, I'd say, in face of Fed and in the face of the Fed and what they've done with interest rates and also kind of the risk-off tone that the market has had. But it's good to see you guys here.
And Jared, good to see you as well, my friend, and thank you for all that insight from the floor of the NYSE. Jared Blickery there. And Microsoft is a step closer now to completing its acquisition of Activision Blizzard, the last remaining agency in the UK that must sign off on the deal, saying the companies substantially address remaining antitrust concerns. This deal is an example of how a company can ride out stricter regulatory scrutiny of the power of tech giants. And this one, Akiko, this is a monster deal. So you're bringing together Microsoft's video game business with Activision's portfolio of hits, Candy Crush, World of Warcraft, right, Call of Duty. Interesting, because there was this moment there where a lot of people weren't so sure this deal was going to get done. There was too much regulatory pushback. There was an analyst, though, from the beginning who was pounding the table saying, you know what, I think they are going to get this done. It is going to get the green light. And that was Michael Pachter from Wedbush, who we have coming up later. There's nobody better to break down the deal.
Yeah, you know, I had to go back and look at when the deal was first announced. It's been a bit of a long road. January 2022, $69 billion transaction, as you noted. This is an interesting one to me because it does point to how Microsoft has navigated the regulatory hurdles. I mean, this decision from the UK essentially clears the way for them to finalize this deal. It was the UK side that came back and said, look, we're concerned about how anti-competitive this could be, specifically for the cloud gaming space. Microsoft came back and said, look, we can transfer these licensing rights to a rival player. So, I mean, they are giving up exclusivity in terms of Activision games, but in favor of moving the deal forward. So I'm curious what Michael Pachter has to say about what this means for an opportunity for Microsoft, but also the gaming space. I mean, cloud gaming overall is not that big just yet.
Very small,
but it's seen as a massive opportunity, which is why this was flagged from the UK Competition and Markets Authority, the official agency. All right, let's move on to another ticker we're watching today. Alibaba shares rise as the Chinese government reportedly looks to relax restrictions on foreign ownership of domestic publicly traded companies. Bloomberg reports China is aiming to lure global funds back to its stock market with those changes. Now, specifically as the numbers stand, total foreign ownership right now is capped at 30%. Single foreign shareholders are limited to a 10% limit. Bloomberg not necessarily reporting where it's going to be moving, but this comes at a time when we have seen a lot of capital leaving China because there are concerns about just how investable the market is. There's also concerns about the macro environment. So this could be certainly positive for the companies, but you have to wonder, Josh, if you are a foreign investor, are you willing to go back into China? Is the opportunity still that big right now in this environment?
Yeah, and I think you bring up the key points, Akiko. One is obviously we were expecting, a lot of people were expecting this kind of post-COVID boom in Beijing. That hasn't happened. It's weak. So I do think you see the Chinese authorities kind of pulling different levers. With this one, though, as you also point out, relaxing those restrictions, we'll see what the reaction is. But just because you build it doesn't mean they come, right?
Well, and we heard Commerce Secretary Raimondo in her recent visit. I keep bringing this up because I think it's significant, who said, look, I'm speaking to American businesses who say China is uninvestable.
Yep.
You know, is that the case? Something to watch.
Yep, absolutely. And also VinFast on our radar today, reporting unaudited second quarter results. Vietnamese automaker seeing a net loss of $526.7 million, while vehicle sales saw a 387% rise from the first quarter of 2023. This one's interesting, Akiko, because so they report, it's the first report, they do report a loss, and you saw deliveries of EVs pop, but I thought it was interesting, a lot of reports quickly also noting, yes, but those sales, a lot of them went to one taxi company there in Vietnam, and it kind of raised this broader question, can they break out of their home country there?
I get the sense that this is one of those companies, Wall Street is still trying to understand how it works, and it's worth bringing up the stock chart because it started trading in August, right? $10 a share when that SPAC merger closed. Since then, it has hit a high of $93 a share, and then you see where it is, back down to $15 a share. So it has already been through a wild ride, but VinFast delivering roughly 11,300 units in the first half of this year. They say they can get it to 40,000, 50,000 in the entire year, but by the way, they just had $70 million left on their balance sheet at the end of Q2. So there's still a lot of challenges ahead for this company.
That chart is brutal.
It is brutal. It's a pretty wild one to watch. We are just getting started here on Yahoo Finance Live. Coming up on the other side, public debuts galore. It has been a busy couple of weeks for the IPO market, but public response has been a bit tepid. We're going to break down the risk appetite in this space. And weight loss drug Ozempic getting a lot of attention in the media. Now the one and only Oprah Winfrey is weighing in. Hear what she had to say. That's up later in the program. And grab your wallet. Apple's new iPhone 15 and 15 Pro are now available, but be ready to shell out a pretty penny. That and much more when Yahoo Finance returns. Let's do a quick check of the market sponsored by Tasty Trade. Just over 30 minutes left to go in the trading week. Markets are street looking to eke out a win on the day, but still looking at losses on the week. We've got the Dow up 54, the S&P 500 up 13, and the NASDAQ up 64. By the way, the NASDAQ and the S&P 500 looking at its worst weekly performance since March is what we're looking at this week. Let's take a look at the VIX, the fear gauge. You know, this is a good metric Jared likes to check, and we are seeing it down about nearly 7% there at 1633.
And consumers are lining up for Apple's newest products, the tech giant's latest smartphone, the iPhone 15, going on sale in China, Europe, and the U.S. And here with a review on the latest addition to the iPhone lineup, we have Yahoo Finance's Dan Howley. Dan, I've been waiting for this one. Very excited for the Dan review. What do you think?
Yeah, I have all of the new iPhones right now. I have these are the Pros right here, and I have the standard iPhone and the iPhone 15 Plus. Really, you know, when it comes down to them, just a general statement, if you have a 13 or 14, you can hold on to those for a little while longer. If you have a 12 or older, then it's worth upgrading to these phones. I'm going to put them all down at this point and just focus on the 15 Pro Max for a moment. And that's because this is the phone that really gets the bulk of the upgrades. Like the regular iPhone 15 Pro, the Pro Max also has a new A17 Pro chip. Apple says that that's great for doing basically anything you can think of with the phone, including playing high-end video games, which is something that you've never really been able to do. It also has the better camera, or the best camera out of the lot. It's got the same 48 megapixel sensor as the iPhone 15 Pro, but the Pro Max gets a new 5x telephoto zoom. So that means if you're zooming in on photos, they're going to look a lot better. And we actually have an example of one that I took with the iPhone 15 Pro Max. You could see this is me at Pier 57, and then I kind of zoom all the way down and can show the World Trade Center down there. And it's just impressive how Apple's able to do this. That's a digital zoom all the way in. This one here is a regular shot of a boat that I saw passing by, and you could just see that I continue to kind of zoom in on here just to show what the iPhone is capable of, and that's the 5x zoom right there. So crystal clear when it comes to the images when you're using that telephoto. The 15 and the 15 Plus get last year's A16 chip that was found in the 14 Pro. They also get the dynamic island that's found at the top of the screen. So now that's across both the 15 and 15 Pro lines, and that's good for things like if you're getting an Uber, you can see the amount of time it's going to take to get to you. If you're doing fantasy football with Yahoo Sports, not that that's a plug, you can get all of your scores at the top of the screen at all times. And my team is terrible, so I'm consistently looking at a losing game, but still, I'm in it. You can also get sports scores as well as control your music from there. And so that's a nice upgrade to see across both the standard iPhone line and the Pro line. The big deal that everyone's talking about, though, is the USB-C connector at the bottom of the phone. They've done away with Lightning, and now we have USB-C right there instead of the old Lightning port. It offers a number of changes, right? It's annoying. It's annoying as hell at first. You're going to have to go out. If you have an older phone that doesn't have a USB-C charging brick, you're going to have to get a new charging brick that's USB-A. So if you also use CarPlay, you're going to have to go out and get a new cable that goes from USB-A to USB-C. So it's annoying to be able to do that. But once you do that, you're going to be able to connect your iPhone to, say, if you buy the new AirPods Pro with USB-C and charge your USB-C charger for those AirPods from your iPhone. If you have a USB-C to HDMI cable, you can stream from your phone to your big screen TV at 4K 60 frames a second. You can transfer data a lot faster between your iPhone and your computer. And if you have the Pro models, you get even faster data transfer speed. So it's annoying, yes, at first, but it's worthwhile. And I think when it comes to these phones, Apple's done a great job upgrading them. But as I said, if you have a 13 or 14, you can hold on to those for a little bit longer.
Dan, you're looking at the 12. That's what I have. I feel like you have given me the green light to go out and get this new phone. Dan Halley, as always, great review there. You can check out it on our site as well. Thanks so much for that, Dan. Well, Apple's latest products will pose a test for the tech giants' growth during the holiday season. Demand and fulfillment of orders certainly going to be closely watched as the company looks to also navigate past some headwinds in China. Our next guest says the company may not be able to rely on strong iPhone sales to drive its share price higher. Let's bring in D.A. Davidson Managing Director and Senior Research Analyst Tom Forte. Tom, you got a neutral rating on the stock and a price target of $180 a share. Something tells me in your notes that you're not that excited about this launch.
No, I think Dan made some excellent points there about why this may not motivate consumers to upgrade their iPhones. But yeah, basically, if you look at either macroeconomic challenges in China, and China's about 10% of sales for Apple, or the fact that, at least from my vantage point, a titanium iPhone or an iPhone essentially with OnStar, things of that nature, I don't think that's going to move the needle for the stock. The company, for its part, already told us that it expects revenue to once again decline in the September quarter, despite the fact they're launching the new iPhone today, September 22nd. So yeah, I think there's reasons to continue to be cautious about the stock, despite the new iPhone lineup.
Here's what the bull case is, Tom, so let me get your reaction. The bulls would say it's less about the features and it's more about that big potential pool of upgraders. And they'll argue, listen, there's about, and you know these arguments, Tom, they'll say there's about 1 billion iPhones out there in the wild. There are hundreds of millions of those phones that are older, 3-4 years. And even small changes, small improvements can motivate those folks to upgrade. What is your response to that bull thesis?
So my response is the most bullish I can get is that the carriers are still wildly subsidizing consumers to get the latest and greatest iPhone. So a month or two before the launch, I was concerned that there would be less subsidies by the carriers. But the good news is they want to leverage the billions of dollars they spent in upgrading their networks to 5G. I still think the 5G network is the best reason for a consumer to upgrade an older iPhone to a newer one. So that would be, I guess, my take on the bull thesis. The good news is that the carriers are still supporting Apple here.
Tom, I want to get back to what you were saying about China. Obviously a big focus here, given Apple gets a decent chunk of its revenue from the market. Is the concern here about the consumer maybe looking at other brands a la Huawei, domestic players, or is it about the consumer pulling back and not willing to shell out that amount of money it takes for another upgrade?
Yeah, it's more the latter. So I'm concerned about the macroeconomic climate in China. I think Apple benefited from an initial boost when the COVID zero policy was ended by the government there late calendar last year. But the fact that you see soft numbers from the Chinese economy, yes, the iPhone, generally speaking, has benefited. Consumers have treated it more like a consumer staple good than a discretionary one. But I am concerned that on a tough macro climate in China, China being 10% of Apple's sales, you may not see the strong revenue there to drive the stock higher from current levels.
And Tom, on China, I'm also just interested in where the business is now for Apple and where you see it's headed. China represents, let's call it roughly 20% of total revenue, but you look at the Chinese economy, it is weak. You look at these geopolitical tensions, they're hot and getting hotter. Where do you see that business down the line, Tom? How does it develop from here? Is 20% perhaps the top for Apple?
So I think that an argument can be made that it is the top. I've been thinking a lot about India through the lens of China, to the extent that, could one point in the future, could they generate north of 10% of revenue from India? I have India as a more focal point in the supply chain, and I believe the answer is yes, though it may take more than a decade. But I do think that you're starting to see some indications that sales may be potentially plateauing for Apple in China. Protectionist behavior by the government there could also be hugely problematic. So I think the China story right now for Apple, it's certainly a risk, and I'm not looking forward to bail out the stock on a near-term basis.
Let me ask you, Tom, final question. You're neutral right now. You're on the sidelines. What would it take to get you excited about Apple, Tom? What do you need to see to move to a buy?
So now that the iPhone 15 launch is in the rearview mirror, I think it's going to be more difficult, but it would be for the Vision Pro AR/VR headset to materially outperform against expectations. We're projecting $5 billion in revenue with it coming out next calendar. We think there's a lot of structural reasons that even Apple won't be able to attain mass adoption in the AR/VR headset category, but that's the new major product release with the iPhone 15 behind us now.
And Tom, I have to ask you too, listen, it's not just about the iPhone, it's also about the watch. Now, I know Apple doesn't break that out, but I think analysts expect that probably accounts for roughly 5% of total revenue. There are some analysts, Tom, they get excited about the watch. They think there's real runway there. They think Apple's going to keep adding new health and fitness features. How do you feel about that product category?
Yes, I think you properly phrased it as far as it being a small percentage of total revenue. Prior to Vision Pro, I would say it was the most successful new product launch for Apple. Though you could also, AirPods would be another one during Tim Cook's tenure. I think that their ability to add more hardware sales and increase the sales away from the iPhone is encouraging. Not as encouraging as the improvement they've had in services revenue, but in and of itself, not enough to get me to reconsider my rating.
All right, Tom, listen, that was great insight. Thank you so much for coming on today. We appreciate it.
Thank you.
And coming up, the Fed hinting interest rates may be held higher for longer. We'll break down what that means for you next.
I think the overriding message, which I think is global really from central banks, is high uncertainty. And so we're emphasizing that we do think this 4% rate will do a lot, but we're also, I think, loud and clear saying, number one, this rate has to be held for long enough to make sure inflation is firmly on its way back to 2%. So there's a lot of power in the messaging that this needs to be held for sufficiently long.
And that was Philip Lane, chief economist of the European Central Bank and former head of the Bank of Ireland, discussing global monetary policy with our very own Jen Schomburger. The ECB raising its interest rates for the 10th consecutive time to a record 4%. The bank indicated it is likely done raising rates, but will hold for a long duration. That's a similar situation to what's happening here in the U.S. Fed Chair Powell indicating rates may remain higher for longer, with the majority of Fed members pricing in one more rate hike. Roughly 27% of bond traders see that hike coming in November. For more on the monetary policy, we're going to turn to Jay Woods, Freedom Capital Markets Chief Global Strategist. Jay, we should note, by the way, we are both at the New York Stock Exchange.
Welcome. Yeah, this is nice.
Yeah. You're a regular here. Let's talk about what we saw play out in the markets post-FOMC decision. We've seen the bond yield hit a 15-year high, at least if you're talking about the 10-year, that's shorter, and the 2-year hitting a 16-year high. In many ways, we heard from our guest yesterday saying, look, the bond market is actually doing the work for the Fed by tightening credit. How do you see this move in relation to the potential for another rate hike in November?
Yeah, well, first of all, the move, the quickness in the move is what kind of scared the market. We broke out above 4.3% in the 10, and we're staying above 5% in the 2s. We're getting a little bit of a pullback today, but it was that, higher for longer that scares us. We focused on the dot plot. The dot plot, when you looked at the last one, we talked about next June being at 4.6%. Now, next June, they're saying 5.1%. So they're saying we're not cutting at all for the next 9 months. That kind of caught everybody by surprise. And then his tone was a little more hawkish than we anticipated. Temper it down a little bit. I know he said the same thing. It was just like pull the string, hear him say, we're data dependent. We'll look at each economic data point as they come. So we'll watch the PCE next Friday and go from there. But he was a little more hawkish than we anticipated. And these yields, while down a little bit today, these historic levels have reason for us to be concerned.
Jay, what's the expectation if you look specifically at the 10-year? Do you see more room to run? We're looking at 4.43 today, 4.5%, inching towards 5%. Where do you see it going?
Well, as a technician, I want to say that this is a bull trap, and this breakout is going to fail, and we'll get back to 4.3 and hold there. But right now, it doesn't seem that way. It seems like the 10 years got a run towards 5%, and that will really throw off basically the high growth names, the technology names, the names that have really been beaten down over the last few weeks that are getting to key levels. So I look at the Qs, then I look at the semiconductors, and there's reason to be concerned. Yeah, you think they're going to hold certain levels, and corrections are normal, and right now this is a normal correction. But if these yields continue to climb the way they've been, it could make the fourth quarter a little more challenging than we hoped.
And of course, that benchmark 10-year, Jay, that's helped set everything from student loans, credit cards, mortgages. Those higher borrowing costs, what's that going to mean for the American consumer? What's your outlook for the consumer?
Yeah, the outlook, the headwinds, first of all, let's separate the economy from the stock market, because the economic conditions, they don't look good. And yes, the headwinds and the student loan repayments, these are things we're worried about. But the market has done remarkably well. At the beginning of the year, it was all about the recession that has yet to happen. And now we're concerned about rates. If the rates slow down, and that's why I said the speed of which they move is important, I think the market can catch up once we get to this next earnings cycle. We're at a point where we're not getting any real earnings. The earnings that we've gotten have been actually good. Look at NVIDIA as a perfect example with good earnings, or a Broadcom, and they've sold off. So I think we need to get through this next cycle of earnings. But yeah, I mean, the headline risk, it's tremendous. And we have a government shutdown looming. That's another thing that we're going to be talking about all next week.
Jay, let's talk strategy here. You mentioned semiconductors, one area you'd stay away from, sort of the broader high growth names, not necessarily a good play when you're looking at higher rate environment. Does that ultimately just lead you with the value plays? I mean, what is a safe bet when there is so much uncertainty around not just central bank policy, but the economic direction?
Yeah, and that's great. And what you want to look for are those safe havens. We're starting to see them pick up. We're starting to see utilities pick up. I think all 11 sectors are down right now, or they were before I got on the air for the week. But you look at staples, you look at utilities. If someone's skittish right now, I think they're great entry points here. And then when you look at the staples, you look at names like a General Mills that is down 30% from its summer highs. Hershey's the same way. They're coming to good support areas, good risk reward setups that I think it's worth putting money there if you want to stay in the equity play, to just look at something like that. And then the big name stocks in the staples, the Walmarts, the Costco, which reports next week, Constellation Brands, they've done remarkably well this year. So I think strength will get strength in the staples, and then you'll see what will happen if people go into those names. You'll look for some value plays, and you'll get it in a General Mills or Hershey's, Conagra, another name.
All right, Jay Woods, thank you so much for that. We appreciate your time today.
Thank you.
And investors are dumping equities at the fastest pace since December as the prospect of higher for longer interest rates raises the risk of a recession. That's according to Bank of America. Let's bring in Josh Schaefer for more details. Josh.
Hey, Josh. Yeah, so I got the chart of the day here right next to me, courtesy of Bank of America, and it shows those equity asset flows going negative. So what you're looking at here when you look at the purple lines, that would be equity flows going negative. If it becomes below this white flat line we have here, you can see the spread with our nice little arrow pointing to the largest drop we saw this week. That's through Wednesday, that we had seen since 2022. So again, that really comes from that higher for longer stance from the Fed when we're talking about interest rates. And so I want to take a look at that as well. This is the dot plot changes that we saw for economic projections for interest rates earlier this week. In purple, you're looking at June. In blue, you're looking at September. So you can see pretty easily here, purple comes up to where blue is. Purple comes up to where blue is. Even go into 2025, guess what? Purple is up higher. Blue is up higher than where purple was. So you're seeing that higher for longer stance in the dot plot that caused investors to sell off over the last couple of days. We had the S&P 500 fall by more than 2% from after the Fed meeting Wednesday through the end of yesterday. A little bit of a rally today, but still overall probably going to close this week down. But there is one investor out there, Tom Lee from Fundstrat, who is still bullish on stocks. And what he points to is why the Fed is coming up with this higher for longer stance. So what I have here is the Fed projections for GDP, for economic growth. What you're looking at in blue is what they predicted in June. You can see a lot of those came up, right? We went from 1% to 2.1% for growth this year, 1.1 next year to 1.5. So the Fed is thinking the economy is going to grow more. That is what's driving their stance to maybe hike one more time. And what Lee argues is that's overall good for stocks because guess what? If GDP is going up, that means the economy is growing. That means price to earnings ratios probably go up and businesses are actually doing well because again, the economy is growing. We're not in a recessionary environment if the reason the Fed is cutting is because the economy is doing well. One other positive note to leave you guys with on a Friday, I want to take a look at a little bit of seasonality here. So the S&P likely is going to fall over 1% in September, just as it did in August. The last 3 times that happened, here are your returns for October. Take a look at that, up 8%, up 8.3%, up 10%. So we've had bad seasonality through the end of September here, but Lee and some other strategists out there highlighting that might change come October, guys. At least that's what history tells us.
All right, Josh Schaefer with some potentially good news heading into the weekend. Josh, thank you.
Yeah.
And coming up, the IPO market seeing a lukewarm reaction to public debuts from Instacart, Arm, and Claviyo. We'll ask one venture investor what it all means for the space. That's after the break.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Shares of marketing automation company Claviyo trading lower today. It stocks off about 1.5%, though still up about 10% since that IPO. We're seeing similar moves from Instacart and Arm. For more on the IPO market, we turn to Byron Dieter, partner at Bessemer Venture Partners. Byron was an early investor in Twilio Box and DocuSign. He's also chair-elect of the National Venture Capital Association. So Byron, thank you for joining us today.
Thanks, Josh. Always fun to talk tech with you.
So, Byron, let me start here. Just your reaction to the public debuts, Byron. You saw Arm, Instacart, Claviyo. What did you make of the reception they got, Byron? What does it tell you about risk appetite out there?
Well, I think they were well-run processes, and we see the buy side moving a little bit from fear over to greed. In an absolute case, Instacart and Claviyo are trading at roughly $10 billion, Arm north of $50 billion. These are highly valued, high-quality companies, and hopefully show signs that the IPO markets will be opening up in the months ahead.
The big question, Byron, I think a lot of investors want to know, though, is do you think this trickle of IPOs, does it turn into a stream, a flood? You know, what's your outlook for that, and what does that depend on? What variables?
I do see it opening up. We've got a timing issue here where we're going into some seasonality with Thanksgiving and Christmas. But the shadow IPO pipeline, which includes now hundreds of high-quality billion-dollar-plus companies, is building. And you're hearing rumblings now of these companies starting to dust off their filings that have been on hold for the last 2 years. And they're looking ahead to early 2024 to try to hit that market. And so I think we're going to see a slow buildup. And I do think late Q1, where people can drop in their 2023 audited financials into that March window, through June will be a really active period. I don't think we're going to go back to the 100-plus IPOs that we saw at the record levels in 2021, but I absolutely think we're going to be well off of these anemic levels over the last 2 years.
Byron, you could argue, at least in the public markets, investors have become a little more discriminatory. Yes, they like the high growth companies, but they also want to see a very clear path to profitability. When you consider where these companies, we're talking specifically about names like Claviyo as well as Instacart, where they have performed at least in the initial days, and you look at who's lining up on the sidelines, on the private side of things, you think there's enough companies that are ready to test the market with investors, with investor expectations where they are?
So I think that's a key question, as we've definitely seen investor appetite move more towards short-term earnings. And it's a rational response. Rising interest rates causes an increased cost of capital. They want to see shorter payback periods. They want to see this trade-off from growth at all costs over to efficient growth. And that's why it took a high-quality company like Claviyo to open the market on the software side. They're growing at over 50%, but they're also generating 8% free cash flow. And so it's a very efficient growth model. To get to over $650 million of annual recurring revenue, they only burned $15 million over their entire life cycle. And so that's the type of company that the buy side was waiting to open the market. And I think you're right that we're going to see companies that are free cash flow positive or very close to break even that are going to start to test the waters next. And then as that buy side starts to move more towards greed, I do think we're going to see companies that are in the hyper-growth mode and burning a few bucks that'll probably test the water middle of next year, but it's going to be an efficient mindset, and it's going to be a subset of those 300 plus companies that are in the queue that will probably push to the front with that efficient mindset.
Byron, when you look specifically at Instacart's debut, there was a lot made about, where they were in their last private funding round, valued at roughly $39 billion versus where they debuted in the market, roughly $9 billion. Is the expectation here matching now increasingly? In other words, these companies that are still private, are they expecting largely to maybe have to take a bit of a cut in valuation in order to test the public markets?
So that's a dance that's going on. And I do think there have to be some reset expectations as the private multiples come down to meet the public multiples, and companies that want to make that transition have to adjust. Obviously, a lot of the private companies are growing into these compressed multiples, and in absolute case may grow back into those valuations. And that's what a lot of them are hoping to do. But we do expect to see more of the Instacart-like financings, which are great outcomes in an absolute sense, $10 billion plus values, and yet the investors have to absorb some valuation compression, just like the public investors did. We all saw these numbers come down meaningfully over the last 2 years, where public multiples compressed by 50% or more. And so it's quite logical that the private companies will have to endure some of that as well as they make this transition to public life.
And Byron, last question here. The name of the game is still AI, Byron. You listen to these companies making their debuts, and ARM and Claviyo, they would tell you, listen, they are smart ways to play this AI theme. Is that just part of the story now, Byron? The companies going public, do they feel like they have to hit that theme if they're going to try and win over investors?
There's a little bit of AI washing, we call it, that's going on. Sprinkle a little of the AI pixie dust on your story and get a little kicker. But I do think you're going to start to see the companies that are fundamentally AI at their core and are benefiting from that. Probably the most closely watched IPO for next year on the software side will be Databricks, which has a real AI story as they're battling with Snowflake. And then as you look into the earlier stage markets, we do believe on the venture capital side that AI could represent the most fundamental transition over the next decade in software. And it may be on parity with what we saw from cloud computing over the last 2 decades in terms of long-term impact. And we're extremely excited about what that means for the future IPO pipeline in the years ahead.
AI washing. I get the sense we're going to start to hear a lot more of that in the coming weeks. Byron, Dieter, it's good to get your perspective today. Bessemer Venture Partners. Appreciate the time.
Always a pleasure. Thank you.
Well, coming up, the closing bell on Wall Street, we're going to check in on the latest market moves and the top trending tickers. Stay tuned. closing bell on Wall Street. You're taking a look at the live image on the floor of the New York Stock Exchange. We've got U.S. Ambassador to the UN, Linda Thomas-Greenfield. There, with the closing bell today, of course, this has been the UN General Assembly this week, so she's sort of taking the honors on this Friday. Taking a look at where all three majors are closing here. Red across the board, pretty fitting given the week that we have had. The Dow down 106, the S&P 500 down 10, and the NASDAQ down 12. This market check sponsored by Tasty Trade. Of course, we've been also watching bond yields on the back of that FOMC decision as we continue to see the 10-year and the 2-year at very elevated levels with that credit tightening. We had that guest earlier today, Josh, saying that he thinks it could even go to 5% with the 10-year. But let's talk about some of the stocks that we're watching. All right, well, let's check in on some of today's top trending tickers. Shares of the big three automakers moving in some different directions here following an announcement by the UAW this morning to expand the strike against GM and Stellantis. Ford shares up. You can see they're about 2% as progress is being made, Akiko, on a deal. Yeah, and we're starting to get some numbers 1 week into this strike in terms of the impact. Deutsche Bank coming out with an estimate saying GM, Ford, and Stellantis have now lost production of more than 16,000 vehicles. Another research firm here, Anderson Economic Group, saying that the three car makers have suffered economic losses of more than $1.6 billion. We've heard, of course, over and over that this is about the pain point that's caused on the big three the longer this goes on. Ford getting a bit of a reprieve today in terms of UAW expanding their strike, with the union saying they believe that Ford has come to the table in good faith. GM and Stellantis will be watching as well, but we're now talking about, 38 additional parts distribution centers that are being targeted. And I think we've talked about this. The UAW strategy is so interesting here to me as well. It's a different kind of strategy under Sean Fain. And really, I think a couple of points he's trying to do here. One, he keeps the automakers kind of on their toes. They're uncertain. Where's he going to hit next? I think he keeps his employees, engaged, right? And I think he also keeps this story, importantly, front and center. Yeah, and part of that is also to be able to, for workers to be able to continue to work, but also keep that fund with the UAW, right? That allows exactly those workers who are on strike to get paid. All right, another stock we're watching very closely today, shares of Apple closing the day. Let's see where it is. Up about 0.5% there. This coming as its latest product hit stores today. This includes the new iPhone 15 lineup, the Series 9 Apple Watch, and the second generation AirPods Pro. We heard Dan Haley today saying, look, if you've got a 14 and a 13, just hold that money. But if you've got a 12, maybe it's worth the upgrade. And that's going to be sort of the growing theme. I think it's not about, whether in fact there are monumental changes between these phones, but to the point you made earlier, is this enough to get even the 12 holders, myself included, upgrading because they need that cycle to go?
It's 12. Come on, Akiko, it's time. It's time.
But it's working fine, right? I looked at it this morning. I thought about it and said, look, I don't have an issue with it, but I do need to get a case. By the way, we both go without a case. I realize that.
No, that's how I roll.
It's kind of dangerous.
I think you're bringing up a good point. This is the central issue for Apple investors, right? You're thinking about, listen, did Apple do enough to get enough people all around excited enough to go out and buy this phone, spark a meaningful upgrade cycle, and re-accelerate growth of this company?
Yeah, D.A. Davidson's Tom Forte earlier, again, saying that I'm just going to stay neutral right now because I'm not sure there's enough units there to be sold.
And shares of McDonald's higher today after the company announced it will be raising royalty fees for new franchise restaurants in the U.S. and Canada for the first time in nearly 3 decades. Fees are being hiked to 5% starting January 1st. So this one's interesting, Akiko. In part, how do the franchisees actually respond and react here?
We're looking at a change of 4 to 5%. May not seem that significant, but the backdrop is an interesting one. If you think about McDonald's, 95% are run by franchisees. This doesn't affect current franchisees, but there's also been a bit of a testy relationship between those two sides. Remember, there was a research report that came out earlier this year that pointed to a 1.71 rating out of 5 in terms of how franchisees rated their relationship with corporate. So does this affect that? Are they going to get a backlash? These are things we still have to look at to see, 4 to 5%, how significant is that increase?
One to watch, for sure. And the job market is on the up. Overall inflation is trending downward and the much predicted recession has not materialized, but voters don't seem to be noticing. Biden and his rival Donald Trump are neck and neck when it comes to voter support, according to a new survey by Yahoo. So why is Biden proving so unpopular? Well, Yahoo's Rick Newman has solved the mystery. Rick, what is it?
It's real household income. It's sitting there right in plain sight, and we kind of know this, but we kind of didn't. And the Census Bureau, once a year, it does this big report on income and poverty in the United States, and the answer was sitting right there. They found that real median household income, that means it is adjusted for inflation, has fallen by almost $2,000 since President Biden won the presidency in 2020. That's almost 3%. That is a lot, and the reason is no secret. It's because of inflation. So during that time, incomes have been going up, but inflation has been going up by more, and that's why real household incomes have been declining. And any Democrats who were scratching their head and saying, well, I don't get it, we have great job growth, the unemployment rate is really low. Why do voters give President Biden no credit for the economy? That's the reason. It's because the purchasing power of the typical paycheck has declined. Now, this census data is a year old at this point, so this could get better for President Biden. We know that trend has actually been improving. Real incomes actually turned from negative growth to positive growth in June. So that means the typical family is just starting to catch up lost ground in terms of purchasing power. So maybe another 12 months of that put us into the home stretch of the 2024 election, and voters will start to feel pretty good about the economy. But if you wonder why they are not feeling good about it right now, that is the reason. The typical paycheck buys less.
Yep. Rick, I'm going to continue to advocate for you to have a direct line to the White House. You have given a lot of insight on where the voter is right now. But, look, we're talking just over a year out until the president's, re-election bid. What do you think is kind of the timeline he needs to work with? Because a lot of this is about turning sentiment around. That doesn't catch on really quickly, even if the economic data turns.
Right. So, and there's also a difference between facts and messaging. So whether you can actually get people to notice the good things that are happening, I think Biden is not doing a great job of that. And in some senses, this is going to be a horse race, not so much between Biden and Trump, if Trump ends up being the Republican, but between Biden and the direction of the economy. Will it improve enough for voters to start giving Biden a little more credit and give him good chances of winning re-election? I mean, for just to put this in context, Biden's approval rating is now about 41%. You want to be at least at 45% to have solid odds of re-election, and 50% would probably guarantee re-election. So can Biden get from 41 to 45% in a year? Sure, he can. He needs nothing to go wrong, and he needs people to start feeling a lot better about inflation. And guess what? That involves gas prices as well as everything else. So behind the scenes, I've written about this. I have a feeling I'll write about it some more. The Biden administration has been doing things behind the scenes, talking quietly with oil producers such as Saudi Arabia, and even making deals with Iran to get more oil onto global markets. That clearly is sort of a re-election play. Let's see what else happens. That's going to be
Sorry, Rick, it's a little loud out here, but we look forward to those other columns I know you've got lined up there. Rick Newman, as always, thanks so much for this week's Bidenomics. Well, negotiations between the Writers Guild and Hollywood studios are continuing for a third straight day without any resolution just yet. Both sides indicating progress being made after more than 3 months of these strikes continuing. The CEOs of major studios back at the table today after negotiations extended into the night yesterday. The work stoppage continues to ripple throughout the economy, with the impact extending well beyond the industry. Joining us now is Kevin Clouden from the Milken Institute. Kevin, it's always good to get your insight because you in the past have said, look, the ripple effects could be $4 billion. You up that to $5 billion. As things stand right now, what would you, or how would you characterize the impact beyond Hollywood?
Well, the biggest impact beyond Hollywood is the massive uncertainty in what it's creating for everybody in the workforce who's tied into and depends on it. You hear stories about evictions, especially since the eviction moratorium was lifted in Los Angeles. You hear stories about people holding garage sales, various things, selling off extra materials, looking for other jobs, which is what happened previously. The last time we had a strike in 2007, 2008, a number of people jumped into other positions. But it also has effects on everybody who's tied into it, where, unlike some actors and some other people in Hollywood who are part-time and always had contingency plans, if you're working for a service company, like if you're working for a dry cleaner or you're working for a camera rental company or something like that, where you expect to have a certain steady demand and you suddenly don't, well, you can find yourself out of a job. And if you're a business owner, you can find a tremendous amount of pressure on you.
And Kevin, have there been other strikes you've tracked in the past that have this same type of similar economic impact, this kind of ripple effect you're discussing here?
Well, there are a lot of different strikes that have massive ripple effects. But in terms of Hollywood, the interesting one is because this is both the writers and the actors, it's more of a complete shutdown and more of a complete shutdown everywhere. When you had the writers' strike that happened last time, and even the longer strike that was still slightly longer in 87, 88, you had a number of cases of people filming things with placeholder sort of compilation episodes and fake scripts and various things like that. You can't even do that right now. So the content just isn't really being generated. And last time, reality television filled the void to some extent, but now, there's a limit. There's even a limit in reality TV. There's a limit to all of it. So everybody is feeling the pinch. The studios can claim that, they're still getting the revenue from the things they've already done, but what it means is they're sort of front loading it. They're taking the revenue now and foregoing that revenue later, and ultimately it catches up. And this time we're just seeing it more at a national level because more filming has moved out of California. We're seeing it in terms of a number of different businesses on the digital side and various services and things like that hadn't really been tied in. And it affects outside the US, obviously, because of the fact that filming in Canada is still largely tied into it, visual effects houses all over the world, various others. So it's more of a global impact and certainly much more of a national impact than it was last time.
Kevin, the reports coming out of this meeting between the WGA and studios certainly promising when you consider where the talks have been up until now. But let's say in a hypothetical, best case scenario, there is a deal reached within the next few days. How quickly do things bounce back based on your assessment from the previous strike?
Well, some things can, happen very quickly. If the studios own the sound stages and they've got things set up, maybe they could get things going within a couple weeks. But you still need to pull everybody back. You need to make sure that your staff is there, all the different levels of workers. You want to make sure they're not committed to something else. You want to make sure that things aren't rented out elsewhere. Because one of the real problems that happens is that it's not just about resuming where you left off. It's who has those agreements in terms of access to sound stages, access to staff, access to rentals. And if on the calendar things can't get pushed back, somebody could jump the line. You could have a production that was meant to start in October that it gets to start before something that's been delayed a few months. But we found last time that it took a year for all of it to basically work its way through the system. And some of it, you'll see it snap back in the same way that it did with the pandemic, where they were able to start rolling pretty fast within weeks. But the ripple effects will go on for months.
And final question, Kevin, I'm interested in how it's not just Hollywood actors and writers, right? If you pull back, this sort of pickup we're seeing in organizing activity across so many different industries and sectors, what do you attribute to that to, Kevin? Is there a common theme there unifying those markets, those industries?
The common theme that you're seeing right now is that the cost of living is just too high. I just to say, not to denigrate or anything else, it's just you just had the report talking about what people feel about the economy and how much of that is inflation. And the truth is that not just with inflation, but we've seen this in things in terms of rents, we've seen this in terms of general cost of living, we've seen this in terms of the overall sense that wages have not kept up. And LA is one of the most expensive places in the country to live. And if you look at the other alternatives, New York certainly is as well. And Atlanta isn't cheap. So all of those pressures add up. And if people, viewed Hollywood as a way to have a middle class lifestyle and they can't afford it anymore, that's driving it. And, for a lot of people, if they're in the auto industry, if they're anywhere else, that, wherever you are in the sector, you want to be able to sustain yourself. And if wages aren't keeping up with inflation, and if they weren't keeping up with medical costs, education costs, housing costs, all of which has massively outstripped inflation, ultimately it adds up. And you're seeing that pressure, and you're seeing that in all different sectors of society right now.
And Kevin Clouden from the Milken Institute. That was great, Kevin. Thank you so much for joining us today.
My pleasure.
And coming up, the mega deal that might just happen. Microsoft moving closer to finalizing that $69 billion purchase of Activision Blizzard. What's left to close the deal? Find out next.
Microsoft is one step closer to completing that $69 billion purchase of Activision Blizzard. The merger clearing a big hurdle today, with the last remaining agency in the UK to hold up the deal, giving it the green light. The Competition and Markets Authority over in the UK saying the company took action that, in their words, substantially addresses remaining antitrust concerns. Let's bring in Dan Halley, who's been tracking this story for us. Dan, you're doing double duty between an iPhone review and a merger deal here, but talk to me about how significant this decision is.
Yeah, it actually is very significant. As far as the deal itself goes, they've basically said everything on paper looks good. There's just a few I's that have to be dotted and T's that have to be crossed, and then it should go forward for Microsoft and Activision. In the U.S., though, there's still the chance that the FTC could move forward with a lawsuit after the deal is closed and then potentially try to seek to break the two apart. We're still waiting on what they're going to do after they pulled back on their initial lawsuit seeking to block the deal from moving forward. But as for what this means, $69 billion would be the largest deal in the gaming industry, and it would make Microsoft the third largest video game company in the world by revenue behind Tencent and Sony. It would also mean that cloud streaming is essentially here and seemingly coming closer to being more mainstream. The big deal about this with the CMA was that they didn't want Microsoft to take over the cloud gaming arena. They already have their Xbox cloud gaming service. It's very robust, especially compared to the competition. Sony has something as well, their own cloud streaming service, but it just doesn't have as much as what Microsoft has to offer. Microsoft also has its Azure services, so it can use its own cloud infrastructure, so it doesn't have to worry about paying out for other cloud services to run its own game streaming platform. So the idea here is that Microsoft would have now Activision Blizzard, Call of Duty, these big titles, be able to block them from other services, other streaming platforms. They said that they won't. They agreed to deals with Sony and Nvidia, Nintendo for some reason, even though the Switch can't run any of this stuff. And now they're saying, okay, we're going to work with Ubisoft. We're going to give our cloud streaming rights for Activision Blizzard games to them, or sell them to them. Ubisoft can then provide those games via the cloud to any other service, and we will also be one of them to be able to purchase them from Ubisoft and offer them on Game Pass. Now, we were talking about the FTC. The UK is not a massive gaming market. It's large, but it's not one of the biggest. The EU was the bigger fish to fry there, and they managed to get past that. The US is a completely different story. If the FTC tries to say, look, you've agreed to these terms in the UK, why can't you do them in the US? I think Microsoft and Activision would balk at that because the US is just such a large gaming market that it wouldn't make sense for Microsoft to give up those terms, paying $69 for the company. So, while a lot of this does come down to game streaming, there's also other things to consider. There's the mobile gaming aspect of this. A lot of people in the world don't have high-end PCs to stream games to, or consoles to stream games to or play games on. A lot of this has to do with mobile. And so most people would have an Android phone that they would be able to stream these games to, or play mobile games that Activision Blizzard owns. So there's more to it than just the cloud portion, but it does mean that cloud is a lot more important, or going to be a lot more important in the coming years.
All right, Dan Howley, everything from iPhones to video games, the man does it all. Dan, thank you for your time today. So when and if the deal does go through, what does that mean for gaming at Microsoft? Let's bring in Michael Pachter, Wedbush Managing Director, for more. So, Michael, it does look like we're potentially going to clear the last hurdle here. I have to say, Michael, there was a lot of skepticism from some quarters. People really didn't think this deal was necessarily going to get done. You've always been saying, Michael, that the deal would get done. Why have you always been confident about that, Michael?
Well, first of all, I have to say you and Dan have convinced me I need to grow a beard. And Dan's piece just now kind of reflects how complicated this is and how hard it is to understand. So, Josh, first of all, I'm a lawyer. I practice tax law, but I actually did M&A for 15 years. So I'm deeply educated about the whole regulatory process, especially antitrust. I also have been covering the games industry for 20 years, so I understand the markets, and I looked at this and thought the FTC has no argument whatsoever. In fact, the EU rolled over pretty quickly, and for the right reasons, because there's really no basis to object to this deal. The CMA concessions, in fact, carved out only the EU and then a handful of countries, UK and Norway, in addition to the EU, where Microsoft has a non-exclusive license. Where Microsoft retains a non-exclusive license. They do not have a license to stream in the US. So Dan's saying the FTC can come back now. Microsoft gave up the US streaming rights to Ubisoft. So the FTC has zero leg to stand on. 0.0% chance of the FTC prevailing in the lawsuit. And as dumb as I think Lena Khan might be, she's not dumb enough, if she knows it's a 100% loser, to try to break this company up. It's not going to happen. So this deal's closing. The carve-out's kind of stupid, but Microsoft gave in to the UK. That they were trying to show that they're the protector of the consumer. And in fact, you're adding a layer of expense. Whatever Ubisoft earns from this, the consumer loses. So the UK didn't protect anybody. Dumb deal. It was dumb from the beginning, obvious that Microsoft could win. And so I've been saying that since the day the deal was announced. And pretty much every single thing I said would happen, happened, except for this odd CMA carve-out.
Michael, I'm going to have you switch from your lawyer hat to your analyst hat, because the cloud gaming space, really at the center of this, is still a very nascent space. It's not a big chunk of gaming overall, but I wonder what you make of this concern that was brought in terms of, where Microsoft's, the biggest game console maker would take the games from Activision Blizzard. I mean, what does that tell you about the competition or the rate of growth that we're seeing in this space?
So where the UK was completely off base and just downright idiotic. The guys who own the content are going to control what happens in streaming. And if they license their content to streaming the way the US media companies license to Netflix, they will allow someone to gain a huge competitive advantage. And in fact, what we're seeing, and the strikes reflect this, is it's hurting cable. People are cutting their $85 cable bill, and they're not watching $65 worth of ads. Instead, they're switching to $30 or $40 or $50 worth of streaming services. That is suboptimal. $150 shifts to $50. Somebody lost $100. But guess who gained $100? Consumers. So the Netflix model is good for consumers. Microsoft is replicating that with games, but the difference is you have to buy a console to play console games. So that market is only about 250 million households. And you have to have a pretty good PC to play PC games, maybe in the aggregate 400 million households out of 1.7 billion on the planet, or 2 billion. Microsoft's going for the 2 billion market. So they're looking at streaming as a way to expand consumption of the content and generate more revenue and profits for them by pushing it out. Think mobile phones 20 years ago, when we all paid $150 a month per phone, and now we all pay 40. But guess what? There's 5 billion phones. So there's more profit for everybody, and the service gets pushed out. That's what Microsoft's trying to do. It's brilliant, and the one thing that was holding them back was content. They only produce about one good game a year. Then they bought 6 studios, so they're up to like 2, maybe 3. Then they bought Activision, they're up to 5. So, they're not dominant yet, but they're giving us enough content that subscription makes sense. And if you don't have $500 to buy a PlayStation or an Xbox, it really makes sense to sign up for streaming. So I think they're going to win. I think streaming is going to grow to a couple of 100 million subscribers. I don't think anybody can compete. Google tried, they failed. NVIDIA's sort of trying, they're not doing very well. Sony's trying, they're not doing very well. Who's going to compete? Amazon? I don't think so.
And Michael, there's another personality here I want your take on. That is Activision's Bobby Kotick. You know him very well. Smart, savvy guy. If and when this deal closes, Michael, what is next for Mr. Kotick, do you think? I don't see him as the kind of guy who just sort of quietly rides off into the sunset. What do you think Bobby's next chapter is?
Yeah, Bobby's not a young man, but he's definitely not old. I think he's maybe 60 this year, so he's got some more years left. His brain is twice the size of ours. He's really smart. He's super accomplished, and he's connected. He's also going to walk out of this deal with a couple of $1 billion in the bank. So my guess is Bobby starts some type of private equity firm and uses his knowledge, his connections, and his capital to make deals happen. I think that the market is still pretty young in its advancement. I mean, we're going to ultimately have virtual reality. We're going to have metaverse. Games are going to lead that, and Facebook's not going to win it. So I think Bobby's the kind of guy who knows enough to figure out where the opportunities are and exploit them, I would invest with him. I think he's super, super smart. I would work with him because I think he's super, super smart. So I think he'll create more stuff. I think people will actually learn a lot from following what he does.
My final question for you, Michael. If and when the deal happens, EA and Take-Two, are they also potential takeout targets in your opinion?
Okay, so back to the FTC. Lena Khan hates big tech. So you can kiss off anybody in big tech making a bid for EA or Take-Two. Amazon won't do it, Apple won't do it, Google won't do it, so it's not going to happen on the tech side. The media guys have their own problems. They can't even pay the writers 5% more, so there's no way they're spending billions. And the only one of the media companies other than Sony, who's obviously PlayStation, who's any good at games is Warner Brothers. They're just saddled with debt, so no chance that they buy anybody. That leaves international because the games industry is just not big enough. EA can't buy Take-Two. So that leaves international. I'd say the most likely buyers are Chinese, and I don't think our government's going to approve a deal like that. So the final player, maybe the Saudis, and I'm not really sure what the government thinks of the Saudis. They kind of bought under the radar. They bought Scopely a few months ago for $4.9 billion. Paid about 2.5 times revenue. So that would make EA worth, a lot. I mean, 15, 20, $30 billion. The Saudis would definitely pony up. I just don't know if the government would approve foreign investment in U.S. companies.
Michael, always with the strong takes. That's why we like to have you on Wedbush's Michael Pachter. Good to talk to you today. Appreciate the time. Let's do a quick check of the market sponsored by Tasty Trade. We are ending the week on a down note across all three majors. The Dow down 106, the S&P 500 down 9, and the Nasdaq down 12. The S&P 500 and the Nasdaq posting its worst week since March. Well, coming up, weight loss drug Ozempic getting a lot of attention in the media. And now this one and only Oprah Winfrey is weighing in. That and much more when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Well, Apple launching its latest smartphone, the iPhone 15 today. And for the first time, the device will be available on Amazon. Boost Infinite partnering with Amazon and Apple to bring that device to platform users. It comes as the company looks to make inroads in a wireless space that's been dominated largely by just 3 major carriers. Joining us now, we've got John Swearinga. He's president of Tech and COO of Dish, Boost's a parent company. John, it's great to talk to you today. I should say, at the expense of sounding like I'm making the sales pitch for you, you are making a pretty aggressive price here at $60 a month for an unlimited plan that has a built-in upgrade annually. What are you expecting in terms of the uptake?
Well, first of all, it's a great day here at Boost Infinite and at Dish. We have the new iPhone 15 certified on the Boost Wireless Network, which is a new network for U.S. consumers. And we think we have a great offer. It's $60 a month, iPhone 15, no trade-in required, and you get a new iPhone every year, which we think is great. And we think that we're going to get tremendous uptake and interest in the offer. And look, this is about customer experience, innovating in the stagnating wireless space here in the U.S. And what better companies to partner with than Apple and Amazon to bring a new offering to market? We're doing that today.
How do you get to that price point? I mean, can you talk a bit about how it's structured? I mean, there's obviously the Verizons, the AT&Ts, T-Mobile out there that are obviously competing on this upgrade cycle as well. How does this partnership with Apple and Amazon allow you to compete in this way?
Well, first, I think it starts with the network. We wouldn't have built a new network without being able to create a durable cost advantage. So we've built our network in the cloud. Partnering with Amazon. We entered into that partnership in 2021. We think the ability to provide wireless much more value to the consumer is something where we're going to now have an edge. And it's really now about making sure that consumers understand our offers, what we're here to do, and to get great devices into the hands of Americans. And I think the timing is great. As I move around our business and talk to people, and like right now, I think value is important to people. And with us, you don't have to sacrifice to get value. You're going to get a great experience on a great network. And we've always got you covered because we have other partnerships as well to make sure that based upon where you work, where you live, where you play, you'll have great coverage and you'll have the absolute best product. And we're not asking consumers to settle at all. We're giving them what we think is something where we can compete and win.
And John, e-commerce is important. Amazon's important. I mean, the sheer volume of Amazon packages that show up at my house every day is astounding. But the in-store experience also important, John. People, they go to their AT&T stores, their Verizon stores. Are you willing to invest there as well?
Well, first of all, we think we need to innovate and be different. We don't want to enter the fray with 3 large formidable competitors 20 years late. That's not a recipe for winning. So working with Amazon, Apple, and others, we're going to innovate and try new things. And a big step is taken today in that now U.S. consumers who are very comfortable buying very important things from Amazon can also buy the iPhone 15 from us and get a great service offering as part of that. And it's really about taking the friction out of switching and wireless. That's very important to us. We're not confused there. We know that we need to provide an exceptional customer experience, and we think we're ready to go with that. And the role of the store is changing. We don't think about people needing to come into a store to know that they want the device. I think certainly in the case of the iPhone and other leading device brands, people are pretty familiar with what they want, and we think we're going to provide a very seamless and easy way to get that to people with no lines, without having to go into a store on a busy Saturday. We'll help you do that, in your own home, and we'll get you the product, and we'll provide great experience with US-based support to help you get activated and moved on over.
John, when we talk about the wireless space, there's a reason we talk about the big three. They've really had a stranglehold in this space. We're talking about AT&T, Verizon, as well as T-Mobile. How do you become that fourth choice? Who are you going after, and are you competing on value? Where do you see your competitive advantage where three have been so ingrained?
That's a great question. I think, first of all, we've done this before. Dish TV rose to be a formidable competitor in the pay TV space. We did it on value, customer service, and making sure that we were there to make sure that people understood what was available to them. And we're going to do that again in wireless. Dish TV was one of the most successful companies in American capitalism, and we think we've made the right long-term investments to have an incredible opportunity to grow to be a major competitor in U.S. wireless, starting with retail and moving into enterprise as we continue to make investments in our network technology. We've built a network in under 3 years that serves 73% of the U.S. population. And we have the largest network now when it comes to 5G voice. We have 5G voice up and running in over 60 markets, serving more than 100 million Americans. And that number is going up every week, every month, as we bring the new network. And again, we think we'll have a tremendous cost advantage, which means we can invest that into customer offers and providing great experience and investing in unique distribution, like our partnership with Amazon and Apple.
John Swearinga, thank you so much for joining us today.
Thanks for having me. And Boost Infinite's available. We're here.
Thank you, John. And coming up, we'll go around the horn with some of today's top stories. That's next.
Welcome back to Yahoo Finance. Josh Schaefer here with Anjali Kamlani and Prasi Romanian, talking about some stories that caught our eye today. It's a Friday afternoon. Talk about maybe some fun stories. And one story I did have my eye on today was Amazon. They're going to be adding an ad tier to Amazon Prime Video. So if you pay $2.99 a month more, you won't get those ads that they're going to be including on TV shows and movies starting in the beginning of next year. Interesting to see Amazon getting into the ad tier space overall. We know that's obviously been a trend. Netflix has added ads recently this year. Disney has added an ad tier. Interesting for me, though, to see Amazon add this ad tier, because to me, Amazon Prime Video is just something I get with Amazon Prime.
I agree with
so
that.
to make me opt in to pay $2.99 more to not pay for ads, I don't know if I'm doing it. You kind of forget that you don't forget that you get Prime Video, but it's just included in Prime. You know, it's not necessarily a fixed cost that I'm looking at every month. I'm really more looking at it from the Prime perspective than the video.
All right, I'm pretty surprised they went the non-Netflix route. Right, Netflix kept their normal tier and added a free tier with ads, right?
Made it less.
Amazon's like, oh, you want that ad-free tier? We're gonna charge you for it. I'm like, what? Like, you can't just keep it like my thing the same and then make people give them like a cheaper option for, or no price option for their ads. I can't believe they went that route. Kind of makes me feel like Amazon Prime is like a lower offer, like a non-premium offering compared to Netflix, in my opinion.
Well, okay, at the end of the day, it's also just, but like 25 cents per month is what we're talking about right now, okay? So like, yes, in the long run, it is. So in the long run, yes, it is more.
That was like $3 more a month, something like that.
No, sorry. Yes, you're right.
It's $2.99 more a month.
Per month, sorry. So if you, but the point being that it's like such a small amount, right, that we're talking about, that does it then truly impact what your like total cost, right? Like everyone's talking about, well, now that we've gotten into this cut the cord world, like do you then end up paying almost as much for a cable package? And I actually did this for myself because I was curious. I was like, am I getting to the point now where if I add on this $3 a month, am I getting to the point where I might as well just have cable? No, I'm still a little bit under, by a little bit, like $10.
Because when you think about $3, I mean, we can all do that math, right? That's $36 a year.
Yeah.
Realistically, if you use Amazon Prime Video a lot, I think most of us can probably rationalize the $36 over the next 12 months to not watch ads. Because the ads are really going to piss you off.
I watched the NFL game yesterday, mate. I watched ads in the NFL game.
But you're always going to get ads in that NFL game. They're not offering because that's the thing though, right? Is like the live sports are going to have ads. It's really just movies and TV shows. And I do think personally, I've become so accustomed at this point to not having ads that it is bothersome because I have Hulu with ads.
That's right.
And it's so annoying when you start getting ads now. You're so used to the Netflix binge, and then you start getting cut off with the advertisements, and it's not what we want.
Can't do it.
Yeah, fair enough. Okay, well, moving on. Something less contentious, guys. Of course, we know how much of a big deal Ozempic has been, right, in mainstream. But I saw some interesting stock activity today for Weight Watchers after the one and only Oprah Winfrey just made a comment about her not wanting to basically take the drug when she needed to get knee surgery and then lose some weight for that reason. She said, quote, if I take the drug, that's the easy way out. And she, really opened up talking about how much shame she has faced and felt in her struggle to lose weight over the years. And I think that's pretty interesting considering she's on the board of Weight Watchers. We saw that stock take a little bit of a dive on this news. And I don't know that it necessarily makes that big of an impact. We did see one of the analysts saying in a note, quote, Oprah's comments should not be viewed as the nail in the coffin on GLP-1 drugs, but people do hear what she says. So the question is, does this then start to symbolize what we see as a broader discussion of, maybe people aren't going to be, maybe it's not going to be that big a deal 6 months from now. I've been having this conversation with people. Obviously, you guys know I cover the health beat. So, will GLP-1 drugs, will these weight loss drugs be as big a deal 6 months from now? Or is it going to be this passing fad once again in weight loss world?
Fascinating to me to see Oprah, obviously Oprah is going to speak her mind because she is Oprah, right? But when you think about Weight Watchers and her being on the board of Weight Watchers and what Weight Watchers' involvement in GLP-1 drugs this year and kind of finally taking that turn has meant for the stock. When you take a look at that stock year to date, you see a giant bump in May when they announced that they were going to start getting into that industry. It's basically the entire reason the stock is up over 100% this year. Yep. And there were analysts at the time, I remember reading notes back in May, basically saying like it might have saved Weight Watchers as a company, right? Like that was, Weight Watchers needed to get into this business because that's, at least whether or not everyone is going to be using some form of Ozempic remains to be seen, right, of course, but it is going to be a part of the weight loss discussion. And so it seems like Weight Watchers feels like they need to at least be in that space. So you would think people on the board would also sort of be behind that message to some extent.
I will say that, and I'm not a user of the drugs or anything like that, but and I know a lot of people in the medical community, and they say, you know, these drugs are great, but it should be balanced by exercise, proper diet. They go through the whole thing that we've heard for 20, 30 years.
Yep.
But look, this is almost like a magic, like in a bottle, right? Like I literally, people will take this and they lose weight, and then it also helps. I think it was in the same report talking about how some people actually help them with the mental aspect of it too, not just the physical aspect. So I feel like this drug, and I don't use it, I feel like it's a big deal, and I don't think it's going to go away, in my opinion. What do you think?
I think that it does have a shelf life because at the end of the day, you're already seeing reports of people dropping off the drug after some time. Yeah, like after a year or so.
Wow.
Because of the burden of taking it, or they've reached their goal weight, but then what happens is the rebound, right?
You're going to keep taking it forever, right?
Yeah, basically, right. So the cost of it also builds up, right? Insurance isn't paying for it. Employers have stopped paying for it or cut back. There's so many barriers to using it right now. So that's why, until and unless something changes that and it becomes more widely available, I think we're definitely going to be seeing, and there's also shortages to speak of, right? So there's so much going on with it. I don't know. I think it has a shelf life for right now, at least. Yeah.
Well, going from one Hall of Famer, Ozempic, to another. Deion Sanders, my man, Coach Prime time. Well, he's bringing it to Colorado, right? So all this attention there, all the hoopla. 3-0 Colorado, right? 3-0? 2-0.
3-0 Colorado.
3-0, yeah. So he's wearing the shades there. Those are the Blender shades, right? Apparently sales are going through the roof. Bloomberg report today talking about how the CEO of Blenders, Ira, said that they can't keep track of exact numbers sold. That's how fast these are flying off the shelves. You know what else flying off shelves is Colorado season tickets. People are going crazy for them. I heard just anecdotally people talking about them more than the Nuggets, the Broncos, the Rockies suck, but you get the picture, right? So the Deion primetime effect is just amazing, and this Blenders sunglasses effect is just part of that whole thing.
Yeah, Pross. I mean, I'm admittedly basically obsessed with college football, so I've been following this very closely. They were at College Game Day from ESPN was there last week. The Rock was wearing the sunglasses on air, which shocked me. I tuned in and I was like, why is The Rock wearing sunglasses on TV? And it was the sunglasses.
Yeah, I got to add one thing. We have the graphics with Deion got into a kind of an argument with the CSU, the Colorado State coach.
Yep. Oh, yeah.
Talking about, hey, when I'm talking to grow up, take my sunglasses off, that's my mother taught me. And then Deion said, well, it's personal now.
But to get the glasses involved with that, right, is like it's genius marketing. Like there's genius marketing going on from Deion Sanders here. There was a report out from the Boulder Daily Camera, shout out local newspapers, great coverage in the newspaper this morning, saying that they think Colorado has basically earned about the equivalent of $90 million of what they could have spent on ads from earned media from Deion over the last 3 or 4 weeks, essentially. That's how big this has gotten. They had the 5th most watch college football game ever on Saturday. 5th most, and it was at 10:30 at night.
For
Colorado football.
And isn't the Deion effect now like $17-18 million every game day weekend for the community, the Boulder community, right? I mean, the effect is crazy.
I think that this is opening the door to a bigger conversation about what we've seen over the years, which is how do you monetize college football and how do you do it in a way that is sustainable, that actually benefits, the schools. We've seen characters, in the coaching space before. I have to shout out my alma mater, go Gators. We had Urban Meyer. I don't know that he could have done the same thing that Deion is doing right now.
Right.
But, I think it's a different era for sure. And I wonder how many other schools are going to learn this and pick up on it. And to the point of the conference is not being so closed anymore. This also really impacts that and really allows that free flow.
Do you need those celebrity coaches then, right?
Right. Yeah. I mean, as Anja said, you had Urban Meyer at Florida. Florida was already a big school, though, right, and already a football school, so them being successful is great. For Deion to bring this to a school like Colorado that really does need a state school to get attendance up and actually make more kids come to that school feels like it's making actually a little bit of a difference beyond the football field. which is nice to see.
I can see it improving attendance or improving applications for kids next year. I could see that happening.
If he stays.
Colorado, Oregon, they're big underdogs this week. We got to go get ready for that. We'll have more Yahoo Finance Live on the other side, guys.
Time now for what to watch next week. President Biden reportedly to travel to Michigan on Tuesday to support UAW strikes. According to the Washington Post, this is coming after the United Auto Workers Union extended its strike to GM and Stellantis. Former President Trump has already announced a trip to Detroit on Wednesday evening, at the same time as a GOP debate. On the earnings front, Costco reporting its first quarter results. The retailer is showing relative strength heading into its earnings report. Investors can also look forward to quarterly results from Nike. With shifts in the retail industry, China recovery uncertainty will be one of the focal points when the company reports on Thursday, September 28th. And turning to the economic landscape, consumer confidence for the month of September is out on Tuesday. This coming after the index saw a pullback in confidence, reversing that sharp uptick in July. And then later in the week, new data for the Fed's preferred inflation gauge, core PCE for the month of August, expected to edge up 0.2% and rise 3.9% year over year. That will be one of the key economic data points the Fed will keep an eye on when making their next policy decision.
That'll do it for Josh and I on this Friday. Be sure to come back here on Monday. Josh is going to be back here at the New York Stock Exchange alongside Julie Hyman, 3 p.m. Eastern. Have a great weekend.